Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for, and what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome, welcome, welcome. Thank you for listening. My name is Robert Kuhn. You're listening to Destination Retirement. I hope everybody's enjoying their summer. We are headquartered here in the Chicago area, right across from the Oak Brook Mall. So we'd love to see you. If I have or say anything on the radio show that piques an interest, certainly feel free to reach out, and somebody from my team will get you on our calendar, and we will do the best we can to help you in any way that we can, no matter if it's really anything investment related. So 630-492-1912, 630-492-1912. I love to reflect over the years that we've been doing the radio show, and I look and think often about where I want to continue to take the radio show. And we believe in education. I think that the job of any advisor is to always educate and have, conversations regarding or around investments that may be new to you, but are, commonplace in, kind of the institutional / high net worth world. And I look back to where we started the radio to what we're doing today. And I truly am proud that we have had just the response that we've had. We've had those individuals reach out to us that we have had because we're doing something right. And the radio show, I believe, personally, it's different. I believe, I'm pretty confident you'll agree that it's different as well. Most radio shows are just annuity products packaged as investment advice so they can share with you an annuity so they can get a commission. And we have set out to be different. We have set out to continue to grow our educational outreach, and we're going to continue to do that. So I love pulling back the curtain on the radio show. Not on the radio show. I love pulling back the curtain on what it is that we deal with clients, because it can be intimidating for someone to speak to an advisory firm. You feel like you're going to get pitched. You feel like they're going to tell you what you're doing is wrong. You feel like they're going to talk over your head. And in many instances, those are, very accurate assumptions, because a lot of firms are like that. We have set out not to be like that. And if you've met with us and if you've talked with us, you know that that is not the case. So 630-492-1912. You look at the website, and I look at the website, and I look at kind of what are our differentiators as a firm. So what do we do, that is going to set us apart? When you're underwriting or doing due diligence on advisors, it's very hard, candidly, for you to do due diligence on advisors, because you may not know what to ask other than, the generic questions that, ChatGPT or a quick Google search shows you or shares with you on what to ask. But that might be a starting point, but I don't think that those questions are very relevant. And we've had, some conversations with investors here recently that I'm certainly going to share today. So I want to give you an update on the investment side, and we'll talk about the website as well. The bank notes are still pricing very strong, very, in this market with these valuations. We had a tremendous amount of success on our index-based income notes. For those of you that are just catching our show for the first time, these are backed by the JP Morgan, Citigroups, Goldman's, Bank of America's, BMOs of the world. I would consider them to be the most sophisticated, well-capitalized banks in the world. And they are currently still pricing in that 12 to 14% range on an annual basis. And as a reminder, these pay monthly coupons. So if you have any interest in those, obviously, we've created as much education as we can on the website, and it's just very, very important for you to. They're actually very simplistic. You just need to be educated and shown what they are and what they're not. And the problem is most advisors don't do them, and it's not because they're not in my opinion, an amazing investment. It's just more that they're very time consuming. And we've done, I believe over 100 million over the last 18 months of new issuance. Year to date, I think we're on a run rate of close to 100 million in calendar year 2026. Plus or minus. I don't have the exact numbers in front of us, but many people are searching out ways to diversify their portfolio, and diversification to you is going to be different than diversification to us. So the bank notes are still pricing very strong in the income side. Last month, we called it a Mini Mag 7. It was really a Mini Mag 3, but most people know what the Magnificent 7 is. We did the Mag 3 note. It was more of a growth note, Amazon, Meta, and Google. And that actually came in at 22% was the pricing. Can't remember which bank did it. Oh, goodness, what bank did it? Maybe it was BMO. But it may be on the website. I'm not sure if it is or not. KUHNCP.com, KUHNCP.com. 22% obviously is significant. Now those names move, right? And you're going to get paid that coupon as long as those names are not down 30% or more on that monthly valuation. So each month from the date of issue, they'll look at it. And as long as they're not down more than 30%, you get your monthly coupon. If one of them is down, you don't get paid that month. So it certainly is a note that we classify as more of a growth note. But a lot of people want exposure in some form or fashion to those names, and so we'll probably start to do more of those. It requires us to commit $250,000, which is very easy to do. Not you could do 1,000. I could have 250 people that do 1,000 each. And then that gives us the minimum required to do custom notes. Generally, ours are much more. So in the $1 to $8 million range. Because the thing with these notes is the more you give the bank, the better the pricing is. And that's something that, we don't spend a whole lot of time on talking about. But it is. So KUHNCP.com. Also, Bison, the energy strategy. So Bison 2, we've created a 7-day due diligence series. So for those of you just catching the show for the first time, obviously the tax benefits are significant. I have to always preface it by saying I'm not a tax advisor. I can't provide tax advice. I don't have the license to give tax advice. So best practice is always make sure that your tax professional or whoever you go to for the tax advice is at least involved in some form or fashion of the conversation. The tax benefits are very straightforward. So we always target $80,000 per $100,000 invested. That can be used to reduce taxable income, active or passive. So we did a 7-day due diligence series, and we're going to start doing a webinar a day. And so if you have any interest in the energy space, the private energy space, partnering alongside of the Exxon, Chevrons, Conocos of the world, and the number one oil field in the world and the Permian Basin. It's obviously something that we have started to talk a lot more about on the radio, but my job is to try to give you as much education before you reach out to us. It helps us because it weeds out those that aren't serious, and it candidly helps you because, again, our job is to really work with those individuals that want to see and seek help. So portfolio construction, I think, is so misunderstood. I just have a very hard time with certain firms that advertise certain minimums and, say we do better as you do better, and just basic taglines like that, right? We were meeting with a potential client this week, and, for the last month or so, and they opted to go with a firm that, again, nationally advertises, manages hundreds of billions of dollars. And the challenge is with those types of firms is really you're just a number. And when we look at marketing and we look at portfolio construction, normally when somebody decides not to work with us, I just thank them and go about my day, because I really only want to work with people who see value in what we do. But there are a handful of firms that I know how they sell, I know how they position their portfolio, and I know that there's a disconnect, in my opinion, between what they're promising and what they're delivering. And so this firm was one of those firms, and so I took an active role with that individual of just trying to educate and, trying to educate that just owning 70 stocks and 25 bonds is not portfolio diversification. For you, the listener who doesn't understand institutional level asset allocation, again, it's not that I'm smarter than you. It's just I have a 30-year or 28-year or however many year head start. And that's all it is. But owning 70 stocks with a bunch of bonds is just not diversification. And so we really had to take a step back with that conversation and really talk about portfolio construction. And portfolio construction is key to everything. And ultimately, it's my belief, will be the greatest determining factor of the success that you have or don't have. So I just took it. And then another thing. And so we, still had ongoing correspondence with this individual. And I give them a ton of credit because generally when somebody makes a decision, they're stuck with that decision just because they don't want to. It's just human nature. You want to think you made the right decision. Well, this individual was open to additional dialogue, additional due diligence, and the portfolio that all he asked was, or all I asked him was, hey, reach out to the firm, get the calendar year performance and the performance of the model that you're invested in, just the model that you are invested in. Well, to his credit, he followed through with it, and they sent back a totally different model. It was a 100% equity model, so it wasn't anything representative of actually what they had. And okay, we went with it and we worked with it. And I ran that model, not my software, third-party software. Everybody reports into GIPS, which, the separate account managers, report into a third-party reporting system. So there's a level playing field. And I said, well, this isn't your model, number one, but let's just run it against the S&P. Now, they didn't benchmark it to the S&P for a whole host of reasons, but generally the benchmarks that they were using, my belief is they're much easier to hit versus the S&P, but I benchmark it to the S&P, and since 95, there was significant underperformance of the S&P. And then we benchmark it to our 100% equity strategy. Now, it's not ours. It's a strategy, third party, that we utilize. And we benchmark it again, same third-party software, and there was a 1,300% difference in performance. 1,300% difference in performance. And this individual would have been none the wiser if he didn't have me that took an interest in just saying, hey, we have to think about this in a little bit more detail. So when we come back, I want to talk more about portfolio construction, and I want to talk about the benefits of concentration. And we're going to talk a lot about that this show. So 630-492-1912, 630-492-1912. More after the break.
Retirement is the destination, and getting you there is what we do. Whatever comes your way, we've got you covered. We're dedicated to providing investment management and strategic wealth planning that are right for you. Simply put, we strive to be our clients' trusted advisor. We've been helping families, business owners, and entrepreneurs just like you get ready for retirement for over 28 years. To talk with Robert Kuhn and his team, give him a call at 630-492-1912 or find out more at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC-registered investment advisory firm. Manage just around $200 million currently for 300-plus families in 24 states. We have decided to kind of hit that growth button and the growth mode as a firm. So we're really proud of the fact that we've had just such tremendous, of you that have reached out from the radio show. And I love doing radio. I love it. I don't have an agenda. I don't have a talking points. I literally, people ask, where do you do the show? Do you prepare for the show? Here's the reality. I don't prepare for the show. I have a mic in front of me and I go. And what I like about the way that I talk and the way that I educate is I try to always bring to you top of mind topics that we are experiencing on this side of the table of an advisory practice. And so that's something that I'm going to keep doing. And hopefully you still find value in that. So 630-492-1912, 630-492-1912. You can go to the website kuhncp.com, kuhncp.com. You can see our most recent bank notes, still pricing, with in the low double digits. The growth notes that we did, the Mini Mag 3, Meta, Google, and I can't remember if it was Amazon or Tesla actually now. We do so many of the notes, I apologize. But anyways, it was a 22% note with 30% downside before you don't get paid your monthly coupon. But I believe that's all on the website. So you can take a look at that. On the energy strategy for those high wage earners, for those who are looking to who've sold a business, sold a piece of property, have concentrated stock positions, and you want to look at deferring taxes and capital gains. Obviously, the energy strategy is a natural place to look. I'm not a tax professional. It's for educational purposes only. It makes sense to always bring in your tax accountant or whoever you receive your tax advice from. But we did do a 7-day due diligence video series that you now have access to if you go to the KCP Kuhn Capital. What is our website? kuhncp.com, and you click on the energy tab. There will be a button there for a 7-day due diligence video series, and if you want to watch all those in 20 minutes, you can do that. So tax benefits have been strong, incredibly strong. We always target $80,000 per $100,000 invested. That's against active or passive income. So we'll never make an investment decision of a asset based on taxes, but it's obviously something that we're very cognizant of because tax benefits in the energy space is significant. One of the areas that I think we haven't talked enough about is your Roth conversion strategies. And for those high net worth investors, those investors that have, $1 million, $3 million, $5 million, $10 million IRA, you probably have been told that it didn't make sense to do that because you're probably in a higher tax bracket. And that may be the case if you don't have a strategy that can defer some of that additional income from the Roth conversion. And so matching those two between the energy investment and a Roth conversion is something that we spend a tremendous amount of time talking about. My planning team can run out the RMDs to age 85, 95, whatever age you think. And those individuals that have large IRAs are in for a shock of what your RMDs are going to be. So 630-492-1912, 630-492-1912. Talking about portfolio construction, and then I want to get into concentration and why most advisors, don't have any concentration for portfolios for individual investors. But when you look at portfolio construction, again, closing the book on the what I was sharing with you on the end of last segment, an individual, that was with a massive nationally advertising firm that hates annuities, that has to have a certain minimum and uses, a lot of taglines. It was, we showed him that, again, past performance is not indicative of future results. That's, something that I think I failed to say. And usually I'm pretty good at those disclosures, but, we were just showing them apples to apples comparison, or as close to an apples to apples comparison as we could get. And having one manager, having a multi-million-dollar portfolio that simply had 50 to 70 stocks and 20 to 30% in bonds is just not diversified, in my opinion. Now, it's very diversified in equities, and it's very diversified probably even in the fixed income strategy. But when you look at diversification, that's not a level of diversification that I believe, if we see a down market, that your portfolio is going to be able to handle that. And when we look at diversification, we have truly 4 distinctly unique sleeves, buckets, strategies, call it what you want. But, we have the growth. I mean, obviously, well, we call it rather protected growth. And that's the bank notes. Now we say protected because it's not FDIC insured, it's not guaranteed. I mean, it's backed by the credit of the bank. But there is a level of downside protection, meaning the indexes or the individual stocks that represent that particular note, they have to go down more than 30% before you don't get paid a monthly coupon. that's really strong. So the market could be down 25%. Those indexes could be down 25%. And as long as none of the indexes breach that 30% barrier, you're still having a positive return for that month. You're still receiving a coupon payment for that month, and they're still pricing, obviously, low double digits, 12, 13%, which is really, in my opinion, very, very strong. So we call that protected growth, and we want some money in that. It could be 10%, it could be 80%. Now, that is identified through the financial planning process, but that alone, that strategy alone, of which we've done, I think, over $100 million of new issuance over the last 18 months. I think we're on a run rate close to $100 million or $80 million for the year. This year, that strategy alone is probably why 50% of the people reach out to us from the radio. And the sad thing is that it's not a new strategy. It's just a complicated strategy for an advisory firm to implement at scale like we do. So most advisors just don't share it. But that's our protected growth bucket. And then we have our growth bucket, and our growth bucket is third party. It's an independent manager that has been running money since 95. I would call them a boutique, big enough to be meaningful, but not big enough that it's just, you're going to have 80 stocks and it's just going to track the index and it's going to be a closet index fund. But, they have continuously ranked. We use their all cap and focused growth strategy. But again, it's third party. We like third party. We like other ways to think about, other money management groups that can think differently than we do. And then it's our job is to bring all of this in a single portfolio, which we're in this kind of portfolio, construction topic and conversation right now. But that performance has been significant outperformance versus the S&P, meaningful outperformance, 1,000%-ish. I haven't looked at it this quarter, so it could be plus or minus, obviously, but it's been meaningful since 95. And that's if you bought and held, of course, but that's real outperformance. And it has a quantitative approach to it. And so it's not a gut feel. It's mathematical models on how investment decisions are made. And past performance certainly isn't indicative of future results. I put a little bit more stock in future performance because of the mathematical nature of it. But again, it's, in looking at any performance, it really doesn't mean anything because, that's yesterday's performance. And unless you were invested in it, well, it doesn't matter, right? Because tomorrow could be totally different. But that's our growth bucket. And our opportunistic growth bucket is our hedge fund, and it's Bison Alpha, and it's a level of concentration. And most advisors are not going to recommend concentration. And I get it. It's, most advisors aren't money managers. Most advisors don't have private funds. Most advisors simply farm out the money management to other firms. And then there's really no risk management when the markets are down, which they'll go down again. We all know this. Then the answer is just to sit and wait. And if that's the type of advisor that you're working with, I caution you, it's been good. But again, just as I have to say past performance is not indicative of future results, well, it is the same thing with investment advisors. When you are down, hearing just sit and wait, the question that I would ask is, why didn't we have anything that, like the banknotes, for example, that could still make money, still pay a coupon if the markets were down to a level of 30%? Those are the questions that I would ask. The questions that I would ask is, why do we have, or why don't we have any protected growth or any defined outcome strategies? So in the level of concentration, and I know we'll talk about this in the next segment as well, but most advisors don't have concentration in a portfolio. And concentration isn't inherently bad. When I look at some of the most successful and wealthy individuals that we have met with over the last 24 months, it's because of concentration. And it's because that they would put in, we've seen people put in $100,000 and it's worth $4 or $5 million over, a 10-year period. Or, the numbers are just are significant, okay? So when you look at concentration, because concentration in the advisory world is sort of shunned, doesn't mean that you shouldn't have a strategy that has some level of concentration in it. And we're going to get back to this at the after the break. So 630-492-1912, 630-492-1912. More after the break. Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, $200 million SEC-registered investment advisory firm. We want to be at $1 billion. We want to be at $1 billion in 5 years, and the only way I think we can do that is to continue to educate investors on what it is and how it is that we see the world, how we see portfolio construction. And we were talking about that at the end of last segment. We are headquartered in Oak Brook. We do work with 300 plus families, 24 states. So it's we're really happy with the growth. But again, I contribute the growth to just doing the job of what I think most advisory firms should do. And so we were talking about portfolio construction. Banknotes, top of the hour, top of the segment, I always like to share with you what the banknotes are doing. Make sure you check out the website if you want to know the current rates, but they're still double digits with 30% downside. Obviously, people are finding those strategies very appealing, given the markets, given the valuations, given where we think the markets could go. It's certainly nice to have that protected growth / defined outcome bucket of your portfolio covered, whether it's 10%, 20%, 30%, 50%. Obviously, that comes with the financial plan. The energy strategy, we have created a 7-day video due diligence series. You can watch it all on one day. They're short videos, but again, if you want to look at true diversification, that is it. The energy strategy has a very low correlation to the S&P 500. It is a private energy strategy. On the website, KUHNCP.com, KUHNCP.com. You can click on the energy link and you can watch all of those videos. You can see all of the data. Tax benefits are significant. I'm not a tax professional, can't provide tax advice. The tax benefits are meaningful in anything in the private energy space if you have the correct strategy. We always target $80,000 per $100,000 invested to be able to reduce your active or passive income. Historically, in our previous funds, it has been higher. But again, we want to make sure that we're just erring on the side of being conservative. So I encourage you to watch those videos as well if you can. 15 minutes, I think, 20 minutes maybe. But if you're interested in true diversification, that's certainly something that we'll talk about. So back to portfolio construction, or we'll talk about that here in a minute, but back to portfolio construction. So it's the banknotes that have our defined outcome, our protected growth bucket. It's the growth strategy that has documented, verifiable, track record versus its peers. They generally consistently rank in the top 2 to 5% of all like managers based upon the reporting software. If you look at the illustration, it gives you the definition of why and how, but it's all third party. So they generally are towards the top of their peer group. Phenomenal quantitative strategy that we love. I was talking before the break about concentration, and so concentration is, most advisors don't believe in it, and we don't believe in it for 100% of your portfolio. We're not saying that you should have 100% of your portfolio in a concentrated stock position, of course, right? But why shouldn't you have 5%, 10%, 15% maybe? Again, it all depends upon your risk tolerance, your financial plan, but that's what Bison Alpha is. It's a relatively concentrated stock portfolio of what we believe to be the best names that are going to generate the greatest rates of return that America has to offer. And currently, it's often in the tech space, but that level of diversification and concentration for 5 to 10 to 15% of your portfolio, why shouldn't you have that? And again, it's just, that when we talk about diversification, that's a strategy that we think, most investors should have some exposure to. And then lastly, the energy strategy, very, very low correlation to the S&P. The cash flow comes in regardless of what's going on in the S&P. very significant tax benefits, very shorter term profile. It is illiquid until there is an exit. We always target 3 to 5 years. Again, that's why you don't put 100% of your money into a strategy like that. There's a private placement memorandum. You have to have $1 million net worth, not including your primary residence, or a couple $100 million of income, $400,000, I think, of joint income. Or now, if you invest $200,000, I guess the SEC will require or will categorize you as accredited. And it's always been a bug of mine that, that there's limits and income limits and net worth requirements on strategies. I don't know if it's good or bad. I personally believe that everybody is able to make their own decisions, but those are the rules. Those aren't mine, but we have to certainly follow them. But that's a diversified portfolio, in my opinion. In my opinion, when you look at, again, we met with a guy, $3 million-ish, plus or minus, and the portfolio was 50 to 70 stocks, 20 to 30 bonds, and that was it. And it's just like, you don't need an advisory firm to invest in a strategy like that. You can go and buy the SPY. You can go and buy the AGG and do a 70-30, 60-40 split and call it a day. I'm just so tired of firms that are holding out their strategies to be sophisticated, to be proprietary, to be unique, to be different, to be able to handle all markets, when we know at first glance it takes us less than 5 seconds to understand that you're going to go as the markets go. Or you can work with an advisory firm like ours that believes in what we believe to be the proper portfolio construction, which is having, I guess in its simplest, we have 4 strategies. Again, we've talked about them a lot. Protected growth / defined outcome. That's the banknotes. Those banknotes are still paying very, very strong. Great banks, BMO, Goldman, JP, UBS, Morgan Stanley, et cetera. And that has a 30% barrier before you don't get paid your monthly coupon. So let's say you had the S&P, the Russell 2000, and the KRE, and we priced it today. Literally on a monthly basis, as long as those 3 indexes from the date of purchase are not down 30%, you're getting your monthly coupon. Simple math, 12% annualized, 1% a month. So you have 30% buffer. So if it's down 25.5%, you are still going to receive your 1%. If it's down 30.0 or more, you're not going to get paid. So that is a great diversifier, bond alternative, hedge, what have you, especially in a market like today. Then we have our growth. Then we have our opportunistic growth, which is our hedge fund, our concentrated best positions in America that we believe are going to give you the most growth. And then we have our energy strategy. So when you look at that strategy versus 50 to 70 stocks and some fixed income, I don't think it takes a rocket scientist to see which and who has real diversification. So if you're working with an advisory firm that just simply buys and holds, charges a fee, only have equity and fixed income, and you have over $1 million, I think you can do better. And I think you should have a conversation with firms like ours, 630-492-1912, 630-492-1912. Especially in this market. KUHNCP.com. KUHNCP.com is our website. If you want to take a look at the note videos, if you want to take a look at our 7-day video due diligence series on our energy strategy, you can do that there. Just go to the energy page of the website. And if you want to set up some time to talk, you can also do that through the website. If you want to attend a webinar on the energy strategy, you can certainly do that as well there. So a lot of ways to get in touch with us. But, the markets, are what the markets are. And many people can't believe that the markets are still doing what the markets are doing. And the reality is, it's an old adage that everybody has heard over and over and over again. The markets can stay irrational longer than you can stay solvent, or you can stay liquid, or you can stay and hold that trade. I mean, there's so many people, unfortunately, that I know that have bet against the market, and it's just been a losing proposition. And but again, if you go back, just go back to 2000. I mean, the markets do go down, and they do go down a lot. It's just a matter of when. And unfortunately, the markets don't ring a bell that says, hey, you need to get your portfolio in order before we, are going to sell this thing off 20 to 30% or 40% or whatever that number is. And, my job is to get investors to really be able to quantify their current strategies outside of just performance, because a newsflash, everybody has done well recently. That doesn't take a whole lot of skill. The real skill is really keeping what you have if we see the markets go down. And so many people sell on fear, and so many of these annuities, these lifetime income annuities, sell on fear. And when you look at what's going on, we've hit the annuity space so hard, but when you look at what's going on in these lifetime income annuities, I mean, my goodness, it's, inflation could just eat up those distribution, guaranteed lifetime income streams that they're going to provide. I mean, that is a massive problem, and I don't think it's a problem that most people have really thought about. And if you do own an annuity, a lifetime income annuity, you have to remember that you are only taking your own money out until that account goes to zero. Once the account goes to zero, then you are in the insurance company's pockets. They're going to write you a check. One way that they prevent that, or they actuarially, in my opinion, stop that from happening, is they put a governor on how much you can take out, and they put a governor on the growth. So you get some growth, just enough, to cover the distribution. But when they're only allowing 4%, 5%, 6%, 7%, and generally the 6, 7, 8, well, I don't know if it comes to 8, but 6 to 7s, you have to be in your 70s. So they know that the accounts are probably not going to zero. And I just get so tired of advisors that's all they sell, and they sell fear. And what they don't sell is how inflation is going to, affect that cash flow stream 5, 10, 15, 20 years down the road. So those are the things that we'll look into it for you. Those are the things that if you bought one, we'll give you some ideas. We'll give you a game plan on, is there a way to get out, what the penalties would be, how long it would take you to overcome the penalties, based upon certain situations. But those are the conversations that we're having a lot. Not every day, but a lot. So 630-492-1912, 630-492-1912. KUHNCP.com, KUHNCP.com. More after the break.
Are you close to or already in retirement, and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 630-492-1912, and find out more at KuhnCP.com. That's KUHNCP.com.
Welcome back. You're listening to Destination Retirement. I am your host, Robert Kuhn, president and founder of Kuhn Capital Partners, who manage a couple $100 million, continues to grow pretty significantly. We want to get to $1 billion over the next 5 years. And the only way that we can do that is to provide ideas. 630-492-1912, 630-492-1912, or visit the website KUHNCP.com, KUHNCP.com. A couple things. There is a bank note. I believe it's on the website. If not, call us and we'll certainly get you the link. But Brian did a short video on the banknotes because, again, it's we believe in education, we believe in transparency, we believe in allowing you to make the investment decisions, not letting or having the advisor tell you that this is the only way to invest. I see far too many people that think they're diversified because of the number of investments that they own, but they own two things: equities and fixed income. That's going to be a challenge. So the banknotes are backed by and offered by the JP Morgans, Goldman, Citis, BMOs, BBVAs, Morgan Stanley, UBSs of the world, still pricing low double digits, 12 to 13% with 30% downside. So if you want to learn how you can utilize those or see if they make sense for your current situation, reach out 630-492-1912, 1912. If you want to view our 7-day video series on the energy strategy, that's certainly on the website as well. Just click on the energy page. The tax benefits are meaningful, significant. If you've sold a business, sold a property, if you're a high wage earner, if you have concentrated stock, if you want to do Roth conversions and look at ways to offset that additional conversion, the income from the conversion. Again, I can't provide tax advice. I'm not licensed to provide tax advice. Best practice is always bring in your tax professional. But the tax benefits in the energy strategy are significant. We target $80,000 per every $100,000 you invest to be able to reduce your taxable income, active or passive. And so we did a 7-day video series, due diligence series on the strategy. You can watch that. Visit the website, kuhncp.com, kuhncp.com. But back to portfolio construction, it's just so aggravating when I see 7-figure accounts have strategies that are nothing more than what we would consider to be closet index funds, equities, and fixed income. I think I've explained and articulated enough this week on this week's show that you just have to be careful. You really have to be careful. You have to be careful if that's all you have. And unfortunately, it takes many individuals losing money before they say, well, you were right. Well, my job, if I'm being selfish, is to try to get you to see that before you before you lose money, before the markets are down 20%, 30%, 40%, 50%. Because a lot of people are comparing this market to the 2000s. And I was in that market. I was managing money, working with clients in the late 90s. And I don't know if it is or if it isn't. I mean, unfortunately, my crystal ball is what your crystal ball is. I don't have a good idea of what's going to happen tomorrow. I have, I can believe in what history tells us. I can believe in the fact that when the markets are at these valuations, the forward return number has typically landed between -2% and 2%. That is real. Maybe it is different this time, and I often do say those are the 4 most expensive words of investing, is it's different this time. But you have to look at your portfolio, and you have to look at how it will do in all markets. That's one of the reasons that we always step back and we when we're meeting with people, is to say, what are you hoping to accomplish, right? Most people will say, well, I don't want to lose money, or I want to make sure I have income that, I can't outlive, or I want to pay my bills in retirement. And so the job of an advisor is to really identify first and foremost what you're hoping to accomplish. And once we know that, then we can really look at crafting a strategy to try to accomplish those goals. But it's not, when people say they don't want to lose money, but yet nothing in their portfolio can deliver a level of protection or the ability to make money even if the markets are down, like the banknotes. And now, again, 30% protection, so that's still good. But so there's such a disconnect between what clients want and what they're given from their advisor. Now, everything has worked when the markets have gone up, so there hasn't been a huge kind of, report card here lately, but it'll come. I don't know if it's tomorrow or when it is, but there's tremendous risk. There's tremendous, valuations are relatively significant currently in the market. I personally don't believe it's like the early 2000s. I don't believe it's like 2008, but you don't need shocks in the market to not do well. And that's what I think most people have to understand. So if you bought Microsoft in 2000s, reinvesting dividends, it took you almost 14 years to get back to even. Now we're cherry picking a date, of course, because you had a big dip right off the bat. And that study or that message could be totally different if you bought it after the dip. But, we have to look at where the market is today. There is a lot of higher levels. The valuations are higher. So what is going to happen? Is it continue to defy gravity, continue to go up, or is it going to revert back to the mean? and we're going to see lower growth periods. Well, I don't know, and you don't know, and your advisor doesn't know. And so we have to have a portfolio that can still, quote unquote, win in that type of a market. And, we always talk about the bank notes. I mean, the bank notes, low double digits backed by, the JPs, Citis, Bank of America's, Morgan Stanley's, UBS's of the world. Clients love those. Absolutely, positively love those. It gives them a level of safety. It gives them a level of cash flow. It gives them a defined outcome. You know the rules before you invest, and that is pretty unique. We have started to talk a lot more about the energy strategy. People want diversification. People want exposure to energy. People are hearing oil prices are significantly inflated and high, and they want to participate in it. Well, our answer to that is our private energy strategy in Bison 2. And the tax benefits, albeit I can't provide tax advice and it's for informational purposes only, are significant. They've been significant, and we target $80,000 per $100,000 invested. So that's a real strong strategy for many potential investors out there. It just all comes back to, portfolio construction. Are you open to ideas? Do you just want more of the same? And it's just, our job is really to just understand your wishes and let you know if your portfolio will accomplish whatever it is that you have hoped for. So throughout the summer, we're going to have some tax summits in our office. Very excited. So we're in Oak Brook. I would envision people flying in for them as well. We're going to start in our office. Hopefully the attendance is so significant that it forces us out of our office and out of our building, rather. And but we're really going to talk about taxes. We're going to bring in a CPA. We're going to bring in a CPA that is licensed to actually legally talk about the tax benefits of energy investing. And the really, I don't know what the title is going to be. It's going to be some sort of a tax summit. But if you're close to Oak Brook, or if you want to come in to the Chicago area, first one is going to be in July. We're finalizing the date now. A couple of our partners were traveling for the month of June, so we did push it out to July. It'd probably be middle of July, so we don't have to fight with the 4th of July and the investors that travel there. But that is for investors who have significant assets. That you may have $2 million, investable. You may have $50 million, $100 million investable. And you want to learn about tax reduction. And we're going to talk about that. We will have a CPA there who could legally talk about the tax benefits of oil and gas investing, energy investing. So we're really trying to up our outreach. We're trying to up our education. We're trying to up our the diversification of strategies that we are bringing to the table. We're trying to get that message out simply because of the market. So as always, if you want to reach out, if you want to get on our calendar, if we've talked in the past and for whatever reason, we you weren't ready at the time, completely understand. Do not feel, reach out again. That's just it. No harm whatsoever. So 630-492-1912, 630-492-1912. Visit the website, new and improved, KUHNCP.com, KUHNCP.com. You can also request a meeting through the website. Certainly, my team monitors that as well. So hope everybody's having a great summer. We'll be back next week.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.